What is it about this? Can you just explain in very simple terms, what is it about calling a snap election in France that's leading to a reaction like this over the last 24 hours?
So ultimately what we saw over the weekend was we had the European elections. We had a swing more to the right than had been expected, particularly in France. So Macron has come out and said, OK, if that's the case, let's have an election on this. And the concern from a market standpoint is that the right wing, the RN party, actually do gain more seats, and ultimately they are tax cutters. They want to spend money. This is France that had a deficit of 5.5% last year, total debt to GDP well north of 100%, downgraded by the rating agencies not that long ago. And the market's basically just concerned around it and saying, hold on, if that's the case, why don't we look at other parts of Europe?
So where's the deficit now? Close to 5.5% GDP?
5.5%. And something like that? Under European legislation, they need to start bringing it back towards 3%. And that's obviously going to be challenged under this scenario.
France is starting to look more like the periphery.
And if you look at what's happened over the last couple of days or so, you've again seen a tightening. I think Spain's something like 18 basis points higher now than France. And obviously that's significantly tighter than it was not that long ago.
Does it make sense, though, that the yields on, say, French bonds and Italian bonds are jumping up, gapping up relative to German bonds, where essentially they're facing the same type of political threat?
They are, but obviously Germany haven't called the snap election, and also you still see Germany as the safe haven asset within the whole of Europe. I think Italy has been impacted somewhat by effectively just sort of dragged around by what's happening in France, and also Italy is a very favourable positioned market earlier this year just because of the additional spread and yield that you're getting on those markets.
To zoom out and sort of go to where we began with Bill Gross, where he was saying basically he sees European bonds as a better buy than the U.S. debt. A lot of people have been sort of arguing that Europe looks more favourable just simply because the ECB cut first. They seem to be on a rate-cutting cycle before the Federal Reserve. Do you buy into that more broadly, despite some of the internecine issues that we've seen over the past couple of days?
I think it's a really interesting question because actually if you look at what happened last week, I think it's a legitimate question, is would the ECB have cut rates with the data set that they were looking at had they not pre-announced it a few weeks ago? And I think that's a really good question that is quite, Lagarde says yes, I'm not so sure. So when we look at the European data at the moment, there's definitely sort of green shoots coming through. And actually, when you look at some of the US data, you could argue we are maybe seeing a sign of softening. So I'm not certain that we're going to have a massive divergence between Europe and the US if you take sort of a longer 12 to 18 month period.